Welcome back to Investing Talk Podcast.
Today, we're looking at Nebius.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find us and lets us keep doing these analyses.
And honestly, for today's topic, you might want to buckle up. We have quite the story.
Oh, yeah.
We are looking at a company that is effectively transforming right before our eyes into what the industry is calling a neo-cloud giant.
Okay.
And we aren't talking about small incremental moves here. We are talking about a company sitting on a staggering, mind-bending $20 billion backlog.
20 billion. Okay. Let's pause and unpack that immediately because that is a massive number. It sounds almost made up for a company that, many people might not have heard of yet.
Mm-hmm.
But I have to play the skeptic right out of the gate here. I've been looking at the sheets, and when I look at the financials, I see a price-to-earnings ratio of negative 141. That is, well, in traditional value investing terms, that's ugly. That is runaway screaming territory. And yet, they are projecting 521% growth in 2026. How do we reconcile those two realities?
It's the classic growth dilemma, but on steroids. And honestly, looking at the PE ratio right now is looking at the wrong gauge on the dashboard.
So what should we be looking at?
The reason we have pulled all this research and are even talking about them is that this isn't really a story about current earnings. It's a play on infrastructure scarcity, specifically AI infrastructure.
You mean the chips and the power, the actual nuts and bolts of this whole AI boom?
Exactly. The market is facing a massive bottleneck. We are looking at a 9-gigawatt supply shortage for the power and compute needed to run these massive AI models.
A 9-gigawatt shortage.
Yeah. Everyone wants to build the next ChatGPT, everyone wants to integrate AI, but there literally isn't enough specialized cloud capacity to train and run these things. Nebius is positioning itself to be the one to fill that void.
So, if I can summarize the thesis then, it's a massive supply and demand imbalance play. Everyone needs the compute, nobody has enough of it, and Nebius claims they have the goods.
That's the elevator pitch. It's about being the water merchant in the desert.
Okay, let's pivot to the numbers then. Because claims are cheap, but execution is expensive. If they are going to grow into this valuation, the revenue trajectory has to be absolutely insane.
Insane is probably the right word. Let's look at Q3 2025. Revenue hit $146 million.
Okay.
Now, in isolation, for a tech company, that's a decent number. But context is everything. Year over year, that is up 355%.
355%. That is hyper-growth territory. Usually when companies get to this size, the law of large numbers kicks in and growth slows down.
But they're accelerating.
Yeah.
And if you zoom out to the first 9 months of 2025, they pulled in $302 million, which is up 437% compared to the previous year.
Wow.
But here is where it gets really interesting. The forecast. This is where the analysts are really sticking their necks out. They are projecting full year 2026 revenue to hit $3.45 billion.
Wait, hold on. Let me just do the mental math here.
Right.
They are going from roughly $300 million in the first 9 months of 25 to nearly $3.5 billion in 2026.
Yep.
That is an exponential leap. That's a 10x move in revenue in a remarkably short window. That sounds almost too good to be true.
It is aggressive, but it gets even bigger when you look at the holy grail metric for these cloud companies.
Yeah.
ARR, or annual recurring revenue.
Right, the subscription money.
Exactly.
Yeah.
Because this isn't a one-time sale. The guidance is suggesting they will hit an ARR of $7 to $9 billion by the end of 2026.
$7 to $9 billion in recurring revenue.
Oh, yeah.
Okay, if they hit that, the current valuation makes a lot more sense. So suddenly that negative PE ratio looks like a temporary blip.
Mm-hmm.
But let's go back to my initial worry, profitability. You can grow revenue to the moon, but if you're burning cash like a bonfire to get there, it's dangerous.
Yeah, you are right to be cautious. The free cash flow is currently negative. There is no sugarcoating that. They are heavily reinvesting every single dollar back into the business.
So they are bleeding cash, but is the wound closing? Is it getting better?
It is getting better, and this is a crucial distinction. The adjusted net losses narrowed by 61% in the first 9 months of 2025. That's a key signal.
Yeah.
It shows that as they scale up, they are getting more efficient. They aren't just spending wildly. They are seeing operational leverage.
Operational leverage meaning for every extra dollar they spend, they're getting more than $1 of value back compared to before.
Precisely. The fixed costs are being spread over more revenue. And the expectation is that they will hit positive adjusted EBITDA That's earnings before interest, taxes, depreciation, and amortization in 2026.
In 2026.
And by 2027, that number could surge to over $5 billion.
Okay, so the thesis is burn cash now to build the factory, print money later when the factory is running at full capacity.
You got it.
But here is the question that always nags me with these smaller cloud players. Why Nebius? Why not just use AWS or Google Cloud or Microsoft Azure? What is this neo-cloud competitive moat?
That's the critical differentiation. It's easy to think cloud is cloud, but that's just not true in the AI era. A neo-cloud is different from the legacy giants like AWS because it is built from the ground up specifically for AI.
Can you break that down? What does built for AI actually mean in practice?
Think of AWS like a massive department store. It stores web data, it runs Netflix, it hosts emails. It's designed for general versatility. But AI training requires something more like a Formula One track. It needs massive throughput and incredibly low latency between chips. Nebius doesn't have the legacy baggage of general-purpose computing. They are an AI specialist.
So they're the specialized tool for the job, not the Swiss Army knife with the scalpel.
Precisely. And that specialization gives them a hardware edge. They are an NVIDIA cloud partner, which is a very exclusive club. This gives them early access to the absolute cutting-edge chips, the Rubin and Blackwell Ultra platforms.
And you can't always get those from the big guys because the line is too long, right?
Correct. The big guys have long waiting lists and massive internal demands. Nebius can often move faster. Plus, Nebius claims an efficiency advantage.
Oh.
They have a proprietary cooling and software stack that they claim is 20% more operationally efficient than competitors.
20%?
Yes. And when you are running tens of thousands of GPUs that eat electricity like crazy, a 20% efficiency gain isn't just nice, it's massive for margins.
And I assume this is why they are landing these big fish. You mentioned a $20 billion backlog. Who is buying this?
It's the who's who of AI. They have exclusive multi-year deals with Meta and Microsoft. Those two giants alone make up a huge chunk of that backlog.
Wait, Microsoft owns Azure. Why would Microsoft pay Nebius for cloud space?
Because even Azure is tapped out. That brings us back to the shortage. Microsoft needs so much compute for OpenAI and Copilot that they cannot build their own data centers fast enough.
So they're spilling over.
Exactly. They're spilling over into partners like Nebius, and that validates the technology. If it's good enough for Microsoft, it's good enough for the market.
That is a huge vote of confidence. Okay, so they have the tech, the customers, the growth. Let's pivot to the charts. How is the stock actually behaving?
It's moving. The momentum is undeniable. Year to date in 2026, the stock is already up nearly 28%. And if you look back at 2025, it tripled in value.
Tripled. So if you were early, you are incredibly happy right now.
You certainly are. And technically, it looks strong. It's trading above its 50-day moving average, which is sitting around $93, and well above the 200-day at roughly $87.
And for our listeners who aren't technical analysts, why do those averages matter?
Think of them as the floor. When a stock is above these averages, it means the trend is up. Traders watch these levels to confirm that the big institutions are supporting the price. If it stays above 93, the bulls are in control.
But it's not a smooth ride-up, is it? I'm looking at the volatility metrics here. This is not a stock for your grandmother's pension fund.
No, it is definitely not smooth. We have to talk about the beta. Nebius has a beta of 4.0.
Whoa, 4?
Yes. For context, the market baseline is 1. A beta of 4 means this stock tends to move 4 times harder than the market.
So if the S&P 500 goes up 1%, Nebius might go up 4%. But if the market drops 1%...
It drops 4. This is a roller coaster. You need a really strong stomach for this one.
No kidding.
Absolutely. But look at the volume patterns. This is interesting. On recent dips, when the price drops, the volume has been lower.
Which suggests consolidation.
Right. It suggests people aren't panic selling. They're holding. But when it rallies, we see high volume. That tells us institutions, the mutual funds, the hedge funds are stepping in and buying the strength.
That's a bullish signal. And I saw a stat in our notes that blew my mind. It said if you had invested $100 10 years ago, it would be worth, what, $779 today?
Something like that, yeah. It's a 22% compound annual growth rate. It shows that despite the volatility, the long-term trajectory here has been massive wealth creation.
Okay, so the chart looks like a rocket ship, albeit a bumpy one. Let's bridge into what the rest of the market is thinking. What's the sentiment on the street?
Generally, it is very positive. If we look at the quantitative scoring from AlphaVantage, which analyzes news flow, they give it a weighted sentiment of bullish.
So the news cycle is on their side.
It is dominated by those massive headlines, the 20 billion cloud deals, the NVIDIA partnerships. It's hard to write a bearish headline when a company is signing contracts that size.
What about the analysts, the people paid to actually crunch these numbers?
The consensus is a moderate to strong buy. We aren't seeing many sell ratings here. As for price targets, they are ranging from averages of about 142 up to highs of 175.
And with the stock trading where it is now, that 175 target implies what?
Right.
Up to 60% upside from here?
Exactly. Even from these elevated levels, analysts see another 60% run in the tank. Firms like Goldman Sachs and Citizens JMP have reiterated positive outlooks. They think the market is still underestimating 2026.
It seems like the market views this as a high beta AI pure play. If you want exposure to AI infrastructure without buying the trillion-dollar giants, this is where you go.
That's the narrative. It's a leveraged bet on the AI build-out. If you think AI is a bubble, you short this. If you think it's the next industrial revolution, you buy this.
Okay, I'm going to put my skeptic hat back on. We've been very positive so far. But a beta of 4 doesn't come without risks. Let's talk about the bear case. What could go wrong?
There are definitely risks, and they are significant. First, we have to look at short interest. It has risen to roughly 15.5% of the float.
That is a high number. 15% of the available shares are bet against the company. That signals that a lot of smart money is hedging heavily or betting on a crash.
It does. They likely believe the valuation has gotten ahead of reality. However, there is a flip side to that high short interest, with only 2.76 days to cover.
Days to cover, meaning the time it would take buyers to buy back all those shares at average volume?
Exactly. Almost 3 days of buying pressure. This is a prime setup for a short squeeze. If Nebius drops a piece of incredible news, those short sellers have to buy back shares to exit their losing positions.
And that buying drives the price up even more. So the bear case could actually fuel the bull case if the bears are wrong. That's like a coiled spring. But what about the people inside the building? I saw some reports of insider selling. That always makes retail investors nervous.
Yes, there have been recent sales by insiders, names like Kira Rudinsky and Arkady Veloz.
So if the company's doing so well, why are the bosses selling?
It's a fair question, but context matters. In high-growth tech, executives often have most of their net worth tied up in stock. They sell for liquidity, buying houses, paying taxes. It doesn't always signal a lack of confidence, but yeah, it can spook the market.
The biggest risk to me, though, seems to be execution. You called it the CapEx trap in our notes. Can you explain that?
This is the operational danger. They have a $20 billion backlog. Great. But to fulfill that, they have to spend billions of dollars on GPUs and data centers now. They are targeting 1 gigawatt of capacity.
And they have to pay for that hardware before they get paid by the customer, largely.
Exactly. And what if they can't build it fast enough? Or what if there is a delay in the NVIDIA supply chain? If they can't get the chips they need, they miss their 2026 targets.
And they'd be stuck with the bill, but no revenue to pay it.
That's the CapEx trap. The market is pricing in perfection. Any delay gets punished severely.
And we also have to mention customer concentration. We celebrated the Microsoft and Meta deals, but isn't that a double-edged sword?
It absolutely is. They are relying heavily on just 2 giants. If Meta decides tomorrow to shift strategy or build enough of their own infrastructure, Nebius takes a massive hit.
It's the all your eggs in 2 baskets problem.
Very expensive baskets, but still just 2.
Exactly. Okay, we've looked at the explosive growth, the volatile charts, the bullish analysts, and the very real execution risks. It's time for the final judgment. What's the verdict?
When you weigh the massive backlog against the risks, the bullish score comes in at a strong 9 out of 10.
9 out of 10. That is high conviction.
It is. The thesis is that Nebius is at a true inflection point. It is rare to see a company transition from $300 million in revenue to over $3 billion in a single year. That kind of velocity just doesn't happen often.
And it all comes back to that supply and demand imbalance.
Exactly. The 9 gigawatt shortage is real. The market is desperate for capacity. Nebius has the hardware, they have the efficiency, and they have the contracts. As long as they execute, and that is the big if, the win is at their back. It is a multi-year hold into that 2026 ARR inflection.
I think that's the key takeaway. If you believe in the AI infrastructure build-out, this is a direct line to it. But, and I have to reiterate this for our listeners, this is a high-risk, high-volatility play. With a beta of 4, you have to be able to stomach swings that are 4 times the market average.
That is the golden rule here. The upside is massive, but the ride will be bumpy.
Well, that's a wrap on Nebius, a fascinating look at a company trying to become a titan in the AI age. Make sure you subscribe to the channel for more analysis like this. We've got some great stories coming up.
Thanks for listening.
See you in the next one.